A central bank is a financial institution that typically functions as the primary monetary authority of a country or a group of countries. Its main objectives often include controlling the money supply, regulating interest rates, managing currency issuance, and overseeing the banking system to ensure financial stability and economic growth. Monetary policy. One of the primary functions of a central bank is to formulate and implement monetary policy. This involves controlling the money supply and interest rates to achieve macroeconomic objectives, such as price stability, full employment, and economic growth. Central banks use various tools to influence monetary conditions, including open market operations, buying and selling government securities, adjusting reserve requirements for banks, and setting the target for short-term interest rates. Banking supervision and regulation. Central banks are responsible for overseeing the banking system to ensure its safety, soundness, and stability. They establish and enforce regulations and prudential standards for banks and other financial institutions to mitigate risks and prevent financial crises. This includes monitoring banks' capital adequacy, liquidity, and risk management practices, as well as conducting regular inspections and stress tests. Currency issuance and management. Central banks typically have the sole authority to issue and manage the national currency. They determine the amount of currency in circulation and are responsible for maintaining its integrity, including designing and producing banknotes and coins, combating counterfeiting, and managing foreign exchange reserves. Lender of last resort. Central banks often serve as lenders of last resort to provide liquidity support to solvent but illiquid financial institutions during times of financial stress. By offering emergency loans or other liquidity facilities, central banks can help prevent systemic disruptions and maintain confidence in the financial system. Exchange rate management. In countries with floating exchange rate regimes, central banks may intervene in foreign exchange markets to stabilize the domestic currency's value or achieve other policy objectives. This can involve buying or selling foreign currencies to influence exchange rates or implementing monetary policy measures to affect capital flows. Clearing and settlement. Central banks often operate payment and settlement systems that facilitate the efficient transfer of funds between banks and other financial institutions. These systems help ensure the smooth functioning of the payment system and reduce systemic risks associated with financial transactions. Overall, central banks play a crucial role in managing the economy and the financial system, with their policies and actions having significant impacts on inflation, employment, economic growth, and financial stability.